What's up, everyone? Today we will be interviewing random people that we happen to see. So let me interview this one, man. Hello? Hello?
Oh, what's up?
There you are.
What's up?
Okay. So how did you get into this position that you are today? Like, what was your occupation to end up in this position?
Well, I was actually a value investor, but I lost everything after I bought this 3/4 of this Bored Ape NFT. I purchased it for $700 million, and it devalued to approximately 73 cents in a couple weeks. I thought I was, making a good value investment. I thought this would skyrocket in price, but unfortunately it went the complete wrong direction. So now I live out here in the forest.
Wow. Sorry to hear that, man. I mean, that's quite embarrassing to say the least. That guy truly really has no clue how to value invest. Look at him back there. Maybe we go find a real value investor. How's that sound? Well, guys, I think we may have found ourselves a value investor here. We're just gonna go ask him and interview him. So, excuse me, sir?
Sorry, some chump's
Yeah,
trying to talk
sorry.
to me. I'll be right back. What do you want?
Hi, sir. Sorry to interrupt, by the way, but I'm just interested. What was your occupation, and what do you do for a living to end up with the wealth that you clearly have now?
Well, I am a very revered value investor in the investing world. My most recent value investment being this French guy holding a plate of bread. Purchased him for around $50. He's worth around $7 million. So obviously a very great value investment. High margin of safety, high potential profitability. I mean, does it just get better than this? Does it get better than this? No,
It really
I don't think
doesn't.
it does. All right,
It
now
really
get out of my
doesn't.
sight. Get out of my sight.
I'm sorry, sir. Very, very impressive,
Get out of
sir.
my sight.
Now, guys, that is what we look for in a value investor. That man right there really knows how to apply value investing, unlike that chump out there in the forest. Speaking of applying value investing, today we'll be diving into some methods that you can use to apply value investing and to end up like this glorious wealthy man that we just met over here.
So the first step in being a good value investor, or just investor in general, is diversification of your portfolio. As you can see here, we have two different portfolios, one being bad and one being good. This one, you may be thinking like, well, these are a bunch of big, brand names, but they are all in the technology sector or heavily reliant on technology. So if something crazy were to occur and say the sun blew up and eliminated all internet, Wi-Fi, power, everything off the planet, all of these would completely plummet and be completely worthless. And we don't want that. So we want to diversify our portfolio and say, get Taiwanese semiconductors, which is in the tech industry, but then several other things like real estate, footwear, and retail, which would remain unharmed in the event of the sun blowing up. So this just kind of proves you want to diversify your portfolio, so if anything drastic happens in one sector, you still have 3 other stocks that remain completely unharmed and completely fine. And this is not just for value investing, but just for investing as a whole. So next important step is monitoring your investments, and you want to check your investments about once per year when the new financial statements are released. And when the new financial statements are released, you're going to want to review those, reevaluate intrinsic value, recalculate margin of safety, and reevaluate important ratios. And we just want to make sure that none of these new values are cause for concern or increase the risk and maybe make the stock overvalued.
Now, it's also very important to know when to buy or sell a stock. So when you're buying a stock, there's no specific criteria to follow, but you're mainly looking for good financial statements, a good intrinsic value that is greater than the current price of the stock, and lastly, a good margin of safety, ideally above 20%, indicating that the current price of the stock is 20% lower than the intrinsic value, meaning there's a lot of room for upside and less risk of downside. When you're selling a stock, you want to make sure that it is not an emotional sale, meaning that if the price of the stock goes up a little bit and you make some profit, or the price of the stock decreases, or there's just some bad news about the stock, you don't want to sell just because of that, but instead you want to sell only when the stock has become overvalued. And this can happen through either price appreciation or value deterioration. Price appreciation is simply when the price of the stock goes above the intrinsic value that you have, and value deterioration is when the intrinsic value of the stock drops below the current price of the stock. And both of these result in the stock being overvalued and therefore a bad value investment to keep. So to cap off the series, we learned about how to apply value investing properly.
We went over diversification of your portfolio and how to confirm that all of your investments are in the same sector. And we also went over how to monitor your investments to confirm that there are no causes for concern with your investment.
And lastly, we looked at what to look for and how to know when to buy or sell a stock.
This has been our series on value investing. Profit to profit, out. That's so corny, bro.